Welcome back to the deep dive. Today we are doing something a little dangerous. We are looking at a topic that usually makes people want to run for the hills, or at least reach for a very, very strong coffee. We are diving into taxation.
It is the broccoli of the financial world. You know it's good for you to understand it, but nobody actually wants to sit down and chew on it.
Exactly. But here's the thing, and this is why I pulled this specific chapter from the NEIS workbook today. We spend so much time obsessing over returns. Is this fund giving me 12%? Is that one giving me 15%?
Well, the headline number.
The headline number. But we completely ignore the leak in the bucket. We ignore what's being lost along the way.
That's the perfect analogy. It's the old adage. It's not what you earn, it's what you keep. You can be the best fund picker in the world, a real genius, but if you don't understand the tax efficiency of the vehicle you're using,
You're just giving money back.
you're essentially running a race with a parachute attached to your back.
Yeah.
You're working twice as hard for the same result.
So that is our mission today. We are going to take Chapter 8 of the NISM Certification Workbook, and specifically, we're using the November 2025 edition, so we are working with the absolute latest rules.
Which is critical.
Yes, including that massive curveball from the budget in July 2024. And we're going to demystify it. We're going to figure out why dividends have this terrible new name. We're going to tackle the capital gains beast, and we are going to decode that alphabet soup. STT. TDS, GST.
It sounds like a lot, I know. But I promise there's a logic to it. Once you see the architecture, the rules stop feeling so, random, and they actually start making sense.
I'm holding you to that. Let's start with the architecture then. Before we get into all the percentages and the cutoff dates, how should we fundamentally view a mutual fund? Because legally, it's not a company, right? It's not like buying shares of a corporation.
No, and that is the absolute fundamental distinction. If you get this one thing right, everything else falls into place. In India, a mutual fund is set up as trust. Yes. And this isn't just some fancy legal label. It has massive tax implications. Specifically, we need to talk about Section 1023D of the Income Tax Act.
Section 1023D. Okay, it sounds like a coordinate on a map. What does it actually do for me, the investor?
It creates what you can think of as a tax shield around the fund itself. Think about what a mutual fund does all day long. The fund manager is buying and selling shares. It's receiving dividends from companies like Infosys or Reliance. It's collecting interest on bonds it holds.
Millions of transactions.
Constantly. Now imagine if the fund had to file a tax return and pay tax on every single one of those transactions. The administrative costs would be astronomical, and the returns would just be decimated before they even got to you.
So Section 1023D basically tells the taxman, look, you can't touch the fund itself.
Exactly. It says hands off the fund. Any income earned by the fund, dividends, interest, capital gains from its trading, is exempt from tax at the fund level. We call this a pass-through vehicle. The mutual fund is just a conduit. It's a pipe. It collects money from thousands of investors like you, puts that money to work in the market, generates returns, and then passes those returns back to the investors.
Okay.
The government has decided that they aren't going to stop the truck at the mutual fund's office. They're going to wait. They're going to wait at your driveway.
That is a very helpful mental image. So the tax truck drives right past the AMC's toll booth, but when it dumps the cash on my lawn, that's when the taxman shows up with his hand out.
Precisely. The tax liability is passed through to the unit holder. You don't pay tax when the fund makes a smart trade. You pay tax when you realize a profit from the fund. That's the aha moment.
Okay, so the truck has arrived at my driveway. I've made some money. Now, looking at my account statement, it seems like the government thinks there are two very, very different types of money in there.
Yes, and this is the next critical step. You have to strictly separate your earnings into two buckets. You cannot mix them. Bucket number one is what we all used to call dividend income.
I'm looking at a statement right now, and it's labeled as, wait for it, income distribution cum capital withdrawal, or IDCW.
Yes. It rolls right off the tongue, doesn't it?
It sounds like a legal disclaimer at the end of a pharmaceutical ad. It's horrible. Why did they kill the word dividend? Everyone understood what a dividend was. It was simple.
They killed it because, to be blunt, dividend was actually misleading in the context of a mutual fund. It created a false impression.
Oh, so.
See, when you own a stock, let's say you own a share of Tata Motors and they pay a dividend. That is a share of their corporate profit. They made money and they're giving you a piece. The stock price might adjust a little bit, but conceptually, it's a bonus on top of your ownership.
Right. It feels like extra cash.
But in a mutual fund, The mechanics are strictly, brutally mathematical. The net asset value, or NAV, is just the total value of all the fund's assets divided by the number of units. There's no magic. If the fund pays you money, that money has to leave the fund's bank account.
Which means the total value of the assets goes down.
It has to. So the fund shrinks. If the NAV is, say, 20 rupees, and the fund declares a 2 rupee dividend, the NAV must drop to 18 rupees the moment it's paid. There's no other way for the math to work.
Oh.
They're essentially taking 2 rupees out of your left pocket, which is your investment's value, and just putting it into your right pocket, which is your bank account.
So income distribution come capital withdrawal is actually the government being brutally honest. They're forcing the industry to say, hey, some of this might be income the fund earned, but a lot of this is just you withdrawing your own capital.
Spot on. It's a reality check in the form of a very clunky acronym. It's meant to make you think about what's actually happening to your investment.
Okay, so that's the name. I get it, even if I don't like it. But the taxation of this, IDCW bucket, has also flip-flopped recently, hasn't it? I definitely remember a time when dividends were tax-free in my hands. I'd get the check or the credit, and I didn't have to report it anywhere.
That was the old regime, and a lot of investors, especially older ones, look back on it very fondly. Back then, we had something called dividend distribution tax, or DDT.
DDT.
Fund would calculate the dividend, but before they sent you the money, they would pay the tax on your behalf directly to the government. So yes, it felt tax-free to you, but your returns were already being shaved by about 28-ish%, depending on the surcharge at the time.
So it was an invisible tax. I was paying it. I just didn't see the line item.
Exactly. But the problem with DDT was one of fairness. It was a flat rate. It didn't matter if you were a billionaire with 100 crores in the fund or a retired school teacher earning very little interest income. Everyone got hit with the same tax rate indirectly.
Which is regressive, right? The billionaire should ostensibly be paying a higher rate on their income.
Correct. So, starting from Budget 2020, the government scrapped DDT. They did away with it completely. We are now in what you can call the new regime for dividends. And the rule is actually very simple to state.
Okay.
Dividends, or IDCWs, are added to your total income.
Just thrown into the pile. With my salary, any rental income, everything else.
Exactly. It's just treated as income from other sources.
Yeah.
And then the whole pile is taxed at your marginal income tax rate.
So if I'm in the 30% tax bracket, I'm paying 30% on those mutual fund dividends.
Plus cess, plus any applicable surcharge. So for high net worth individuals, the effective rate could be upwards of 35%, even 39%. For them, this was a massive, massive tax hike on dividend income.
But what about that retired school teacher we mentioned?
For her, it was a gift. It was a huge benefit. If her total income for the year is below the taxable limit, say 5 lakhs or 7 lakhs, depending on which tax regime she's chosen, she pays zero tax on her dividends.
Zero.
Zero. Under the old DDT system, she was indirectly paying nearly 30%. Now she pays nothing.
That is a crucial distinction. It means the dividend or IDCW option is now almost chemically toxic for high earners, but potentially very, very efficient for low earners or retirees.
Exactly. You can't just make a blanket statement like dividends are bad. You have to ask, bad for whom? The answer depends entirely on your tax slab.
Okay, that's bucket one. Let's move to bucket two, which I feel is where most of our listeners probably live. Capital gains. This is the simple profit I make when I sell my units for more than I bought them for.
This is the real growth engine for most investors. And this is where the complexity really ramps up, because the tax man does not treat all mutual funds equally. You have to know what you are holding.
It's not just I bought a fund, it's what does the fund itself hold?
Correct. The first thing we have to do is draw a hard line in the sand between two categories, equity-oriented funds and non-equity-oriented funds.
How do we define equity-oriented? Is it just a vibe? Like, oh, this feels like a stock fund.
Chuckles. No. No vibes allowed in the Income Tax Act. There's a very strict mathematical threshold. To qualify as equity-oriented for tax purposes, a fund must hold, on average, at least 65% of its total assets in equity shares of domestic companies listed on a recognized stock exchange.
Okay, let's unpack that sentence. 65%, that's the number. And domestic.
That word domestic is the trapdoor for so many investors.
I was just going to ask about that. What if I buy a fund that invests in, the U.S. tech giants, a U.S. blue chip fund, or a NASDAQ Q100 tracker? That's 100% equity. It's volatile like equity. It smells like equity.
It is equity, but it is foreign equity.
Yeah.
So according to the Indian tax code, it fails the 65% domestic equity test. For tax purposes, it is treated as a non-equity fund.
Wait. So you're saying my U.S. tech fund is taxed in the same way as a debt fund?
Yes, exactly the same, and it gets worse. Let's talk about fund-to-funds, or FOFIFs.
Please. This trips up so many people. I see this question all the time.
Okay, so let's say you buy a fund called the XYZ Multi-Manager Equity Fund. It sounds great, but this fund takes your money and invests it in other mutual funds. It doesn't buy stocks like Reliance or HDFC Bank directly. It buys units of other equity schemes.
Right, but the underlying assets are still, at the end of the day, domestic stocks, so
Yeah.
it should be an equity fund, right? That seems logical.
Logic would say yes. The tax law says no. Most fund-to-funds are classified as non-equity because the law says the fund must hold the equity shares directly. Unless the HEFO is investing specifically in an ETF that tracks a domestic index, it usually fails the test.
That feels like a technicality that could cost someone a lot of money. You think you're getting one tax treatment, but you're actually getting another.
It absolutely does. It's one of the biggest gotchas. You could be taking full stock market risk, seeing your portfolio swing up and down by 20% in a year, but when you go to sell, you don't get the favorable tax treatment of an equity investor. You get the, frankly, harsher treatment of a debt investor.
That is a massive red flag. Listeners, you need to check the scheme information document. Do not assume.
Okay, so we have equity, which is 65% direct domestic holding, and non-equity, which is basically everything else.
Yeah.
Now, how does time play into this?
Time is the second critical variable. The government wants to encourage you to be a long-term investor. They don't want you flipping funds like pancakes every week. So they offer a lower tax rate if you hold for a certain period. A tax break for patience.
Exactly. But that certain period depends on the asset you're holding.
Okay, let's break it down. For the equity-oriented guys, the ones that pass the 65% test.
For them, the magic number is 12 months. The holding period is 1 year. If you sell before completing 12 months, it's a short-term capital gain. If you hold for 12 months and 1 day, it becomes a long-term capital gain.
That's a pretty short long-term. 1 year feels quite generous.
It is. It's very generous compared to other asset classes like, say, real estate.
And for the other bucket, the non-equity bucket, that includes all the debt funds, the gold funds, my U.S. tech fund.
For that entire bucket, the holding period is 24 months, 2 years.
So if I sell my debt fund after 18 months, that's still considered short-term.
Correct. You haven't crossed the 2-year line.
Okay, so 12 months for equity, 24 months for everything else. Now, I see in our notes here from the NISM workbook that there is a giant asterisk next to all of this regarding July 2024, the union budget.
Yes. This is the curveball I mentioned at the start. The July 2024 budget fundamentally shifted the rates and, in some cases, the definitions. If you are reading an old blog post from 2023 or even early 2024, you are going to get the math wrong, and that could be an expensive mistake.
What is the key date we need to tattoo on our forearms?
July 23, 2024.
Why such a specific mid-year date? Usually these things start from April 1st, the beginning of the financial year.
That's because it was a vote-on-account budget earlier in the year due to the elections. The full budget was presented in July, and many of the provisions were made effective from the date of presentation. So redemptions, meaning the day you hit the sell button on or after July 23, 2024, fall under the new rules.
And if I sold on July 20th?
You're under the old rules. The transaction date is what matters.
Okay, so let's talk about the money. What are the rates now under this new regime? Let's start with the trader. I bought an equity fund and 6 months later made a quick buck and sold short-term capital gains on an equity fund.
Post-July 2024, the rate for that is a flat 20%.
It used to be 15%, didn't it? For a long time.
It did. It was 15% for years. So that is a direct 5% hike on short-term trading profits from equity. The government is very clearly signaling, stop churning your portfolio. We want you to hold.
20% plus cess. That bites.
Yeah.
Okay, what if I behaved myself? I held my equity fund for 5 years. I'm now officially a long-term investor. What's the damage?
This is where we need a little bit of history to understand the present. It's a fascinating story. Before 2018, long-term capital gains on equity was zero. Absolutely zero. It was the tax haven of the Indian middle class.
The golden era. You bought, you held for a year, you sold, you kept everything.
Everything. But in 2018, the government, looking for revenue, brought in a tax, and then in July 2024, they tweaked it again. Currently, the rate is 12.5% on your long-term profits.
12.5%.
Yeah.
But there is a sweetener, right? I remember reading, I don't pay that from the very first rupee of profit.
Correct. There is an exemption limit, which is a very important part of the calculation. The first Rs 1.25 lakhs of your total long-term gains in a financial year are completely exempt from tax.
Let's do the math on that because exempt can be confusing. Suppose my total LTCG for the year is exactly 1 lakh.
You pay 0 tax. It's below the threshold.
Okay, suppose my profit is 2 lakhs.
You first subtract the exemption. So you take your 2 lakhs profit minus the 1.25 lakhs exemption. You only pay tax on the remaining 75,000 rupees.
So I pay 12.5% on 75,000, not on the full 2 lakhs.
Precisely.
And that 1.25 lakh limit is across all my equity stuff, right? I can't claim it for each fund separately.
Chuckles. Nice try. No, it is per taxpayer per financial year. It covers all your equity mutual funds and all your direct stocks combined. It's one single bucket of exemption.
Got it. Now, there is a concept here that I find fascinating, and it's so relevant for people who have been investing for a long, long time: grandfathering.
Yes, this is one of the most important concepts for older investments.
It sounds like something involving a rocking chair and a story, but I know it's a tax rule that saves me money. Explain this mechanism.
Okay, so when the government reintroduced the LTCG tax in 2018, there was, as you can imagine, a panic. People who had been investing for decades said, wait a minute, I've been holding this fund for 10, maybe 15 years based on the promise that it was tax-free. Now you are going to tax me on 15 years of growth retrospectively.
That would be incredibly unfair. Retrospective tax is a very dirty word in business and finance.
Exactly. So the government, to be fair, instituted a grandfathering clause. They basically drew a line in the sand on a specific date, January 31st, 2018.
Why that date specifically?
That was the day before the union budget announcement that brought the tax back. The rule they created is this: any gains you made up until January 31st, 2018 are yours to keep forever. Tax-free. The tax will only apply to the growth that happened after that date.
Okay, this is a bit abstract. Let's use real numbers to make it concrete. Let's say I bought an equity fund way back in 2010 for 1 lakh. By Jan 31, 2018, it had done really well and was worth 5 lakhs. Today, I sell it for 6 lakhs.
Okay, perfect example. In a normal world, without grandfathering, your profit is your selling price, 6 lakhs, minus your original cost, 1 lakh. That's a 5 lakh profit. You pay tax on that whole amount.
Right.
But because of grandfathering, the tax man does something very generous. He says, I will reset your cost of acquisition for tax purposes. He ignores your actual cost of 1 lakh. Instead, he treats the value of your investment on Jan 31, 2018, which was 5 lakhs in your example, as your new official purchase price.
So for tax purposes, it's as if I bought the fund on that day at 5 lakhs.
Yes, so your taxable gain is now your selling price, 6 lakhs, minus this new grandfathered cost, 5 lakhs.
Yeah.
Your taxable gain is only 1 lakh.
And since that 1 lakh is below the annual 1.25 lakh exemption,
You pay 0 tax on that entire transaction.
that is incredible. So that entire 4 lakhs of growth from 2010 to 2018 essentially just vanished from the tax radar. It's protected.
Completely and permanently protected.
Now let me throw a wrench in the works. Same scenario. I bought at 1 lakh. The Jan 2018 value, the grandfathered value, was 5 lakhs. But since then, the market has crashed. Today, I sell it at 3 lakhs.
The neither here nor there scenario. This is a great question.
Right. It's less than the grandfathered value, so it looks like a loss from that peak, but it's still more than my original 1 lakh investment. So I have made a profit overall. What happens?
In this specific case, the law is designed to be logical. The taxman says, look, your selling price of 3 lakhs is higher than your original cost of 1 lakh, so you haven't really lost money. I won't let you claim a tax loss.
Okay.
But, he continues, your selling price is lower than the value on the grandfathering date, so I won't charge you any tax either. The taxable gain in this scenario is game to be 0. It's a wash.
That seems fair enough. So grandfathering is a massive shield for long-term holders. Check your statements, people. Find out the NAV on Jan 31, 2018 for your old funds. That number matters.
It matters a lot. It could save you a significant amount of tax.
We've covered the headline taxes, the big percentages. But whenever I look at a contract note or my statement, there are these little nibbles, tiny amounts that get deducted. I want to talk about the hidden costs, specifically stamp duty and STT.
The silent eaters of returns. They're small, but they're constant.
Let's start with stamp duty. I thought that was just for buying houses or signing legal documents.
It used to be, but since July 1st, 2020, it applies to the issuance of mutual fund units too. The government essentially said, these are securities, financial instruments, just like property deeds or share certificates.
So what's the damage? How much is it?
It is 0.005% on the value of your investment.
0.005%. That sounds microscopic. Is it even worth talking about?
It is very small. Let's put it in perspective. If you invest 1 lakh rupees, the stamp duty is 5 rupees.
Okay, I think I can afford 5 rupees.
You can. But the nuance is in how it is charged. It is not an extra fee you pay on top. It is deducted from your investment amount before the units are allotted to you. So you aren't actually investing 1 lakh. You're investing 99,995 rupees. You get slightly fewer units than you thought you would.
So it's a friction cost on entry. It just reduces my investment capital from day one. Does it apply to everything, my SIPs too?
Everything, lump sum purchases,
Yeah.
every single SIP installment, dividend reinvestments. Even if you do an STPA systematic transfer plan from, say, a debt fund to an equity fund, that switch in leg is considered a fresh purchase. Stamp duty applies again.
That's a bit annoying. Okay, what about STT securities transaction tax?
STT is, in a way, the opposite of stamp duty. Stamp duty is on entry, as CT is on exit. And crucially, STT applies only to equity-oriented funds.
So debt funds are safe from this one.
Debt funds are completely exempt from STT. But for equity funds, when you sell your units on the stock exchange or to the fund house, you pay 0.001% of the transaction value.
Again, tiny numbers.
Very tiny numbers, yes. But they signal intent. The government tracks every single equity transaction through this. And it also highlights why high-frequency trading in mutual funds is so inefficient. You might have exit loads, which are often 1% if you sell within a year. You have stamp duty on the way in. You have STT on the way out. These vehicles are designed to be parking lots for your money, not racetracks.
Speaking of racetracks and sometimes crashing cars, we all know that sometimes we lose money. It happens. Does the tax man care about my pain? Can I get any benefit from my losses?
He does, but he is very, very particular about how you express that pain. This brings us to the really important concept of set-off and carry forward of losses.
Okay, let's start with rule number 1. If I lose 5 lakhs in the stock market this year, can I deduct that from my salary income to lower my overall tax bill?
Absolutely not. That is the cardinal rule, and it's non-negotiable. Capital losses can only be set off against capital gains. The government is not going to subsidize your bad stock picks by lowering the tax on your hard-earned salary.
Harsh, but I guess I can understand the logic, so I have to keep it within the capital gains family.
Yes, but even within the family, there's a pecking order. There's a hierarchy. You have long-term capital loss, LTCL, and you have short-term capital loss, STCL.
And let me guess, they don't mix and match easily.
Not quite. Think of a long-term loss as the weak loss. It's less powerful. It can only be set off against long-term gains.
So if I have a long-term loss from an equity fund, I can't use it to offset a short-term profit I made on another fund.
No, you cannot. And this is often frustrating for people because short-term profits are taxed at that higher rate of 20%, so you desperately want to use your losses to lower that specific bill. But the law says a long-term loss cannot touch a short-term gain.
Okay, so that's the weak one. What about a short-term loss?
A short-term loss is the strong loss. It's a wild card. It's much more flexible. You can set it off against both short-term gains and long-term gains.
Oh, that is very interesting. So a short-term loss is actually more valuable from a tax planning perspective than a long-term one.
In a way, yes. It gives you more options, more flexibility to manage your tax liability for the year.
Now, this whole discussion of manufacturing or using losses reminds me of a loophole I've heard about. It's called bonus stripping. It sounds like something that happens in Vegas, but I gather it's a tax strategy.
Chunkles. It was a very popular strategy, especially among the rich, but the government has largely plugged it now. And yes, it involves manufacturing a loss for tax purposes.
How do you even manufacture a loss? That just sounds illegal on the face of it.
Well, it was perfectly legal within the rules at the time, just manipulative. Here's how it worked. Imagine a fund has an NAV of 30 rupees. They announce a 1-for-1 bonus issue.
Okay, so for every 1 unit I hold, I get 1 free unit.
Right. But as we discussed with dividends, there is no free lunch. There's no magic money. If the number of units in the world doubles, the price per unit must have to keep the total value the same. The NAV drops from 30 to 15.
So my total value is the same. I used to have 1 unit worth 30. Now I have 2 units each worth 15. Total is still 30.
Correct. But the bonus stripper would play a clever game with the dates. They would buy the units at 30 rupees just before the record date for the bonus. Then the bonus happens, and they get their extra unit. Now they have 2 units at 15.
Okay, I'm with you so far.
Then they immediately sell the original units they bought. They sell them at the new price of 15 rupees.
I see it. They bought at 30, they sold at 15. On their tax statement, they have booked a massive short-term capital loss of 15 rupees per unit.
Exactly. And they would use that 15 rupee loss to offset other real capital gains they had, lowering their tax bill. But did they actually lose any money? No, because they're still sitting on the bonus units, which are worth 15 rupees. They kept their value, but created a tax loss out of thin air.
That is incredibly clever. But you said the loophole is plugged. How did they stop it?
The Income Tax Act now has a specific anti-avoidance rule. It says that if you buy units within 3 months prior to the record date of a bonus, and you sell some or all of your original units within 9 months after the record date, then any loss arising from that sale will be ignored for tax purposes.
Ignored completely.
Ignored for set-off. The taxman says, "Nice try. We know what you did." They do not allow you to set off that loss against any gains. Instead, they take that loss amount and add it to the cost of acquisition of your bonus units.
So you can't actually realize that loss for tax until you sell the bonus units too, much later.
Exactly, which defeats the whole purpose of the strip. The immediate benefit is gone.
Moral of the story seems to be, don't try to outsmart the tax department. They have seen it all before.
They literally wrote the rules of the game. You're just a player.
Let's shift gears from avoiding tax to actively saving tax. The famous Section 80C. This is the bread and butter of Indian tax planning for salaried individuals. In the mutual fund world, the hero product for this is ELSS, the Equity-Linked Savings Scheme.
The tax-saving mutual fund, yes.
Why do people love these so much? What's the appeal?
2 main reasons, really. 1, it gives you exposure to the growth potential of equity. Most other ADC options like PPF or National Savings Certificates are debt instruments with fixed lower returns. ELSS lets you potentially earn 12–15% over the long run while saving tax. And 2, the lock-in period.
It has a lock-in. You can't take your money out.
Yes, but it has the shortest lock-in period of all the popular ADC options.
Yeah.
ELSS is locked for 3 years. For comparison, a PPF is 15 years. A tax-saving FD is 5 years.
Yeah.
So ELSS is the sprinter of the group.
The big but is the tax regime you've chosen. The ADC deduction, that benefit of reducing your taxable income by up to 1.5 lakhs, is available only if you are following the old tax regime.
This is so critical. We are seeing a massive push from the government for people to shift to the new tax regime, which has lower tax rates but practically zero deductions. No ADC, no HRA, nothing. Correct. So if you, as a taxpayer, have opted for the new tax regime, then ELSS loses its superpower. It just becomes a regular diversified equity fund that happens to lock your money up for 3 years for no extra benefit.
So to be crystal clear, if I'm on the new regime, is there any reason at all to buy an ELSS fund?
Not from a tax-saving perspective, no. Structurally, it makes no sense to accept a mandatory lock-in if you aren't getting a tax break for it. You'd be better off with a regular FlexiCap fund that gives you liquidity.
That's a very good point. And regarding that 3-year lock-in, I want to clarify something I've seen trip people up, especially with SIPs in ELSS.
It is the most common misunderstanding about the product. People think the fund has a 3-year lock-in, so if I start an SIP in January 2020, I can withdraw everything in January 2023.
And that is not how it works.
Not at all. In an ELSS SIP, every single monthly installment is treated as a separate investment with its own 3-year clock starting.
Oh, wow. So it's not one clock for the whole investment?
No. The money you put in January 2020 unlocks in January 2023. But the money you put in February 2020 only unlocks in February 2023. And the money you put in December 2022 won't unlock until December 2025.
So it's a rolling lock-in. You can never just liquidate the whole pot 3 years after your start date. There will always be some units still locked.
Exactly.
Yes.
This is a huge deal for goal planning. If you need a lump sum for a big goal like a down payment on a house, you need to stop the SIP at least 3 years before you need the money to ensure all units are unlocked.
That is a detail worth writing down. That could absolutely ruin a financial plan if you aren't careful.
It could, and it has for many people.
Let's touch quickly on TDS, tax deducted at source. If I'm a resident Indian, do I have to worry about the fund house cutting some tax for my capital gains before they pay me?
For capital gains, no.
Sure.
If you are a resident, the fund is required to pay you the full redemption amount.
Yeah.
It is your responsibility to calculate the tax correctly and pay it yourself when you file your income tax returns.
That's good. I prefer to handle my own math and payments.
However, for dividends, or IDCWs, there is TDS. The rule is, if your total dividend income from a single mutual fund house exceeds Rs. 5,000 in a financial year, the fund is legally required to deduct 10% PDS before crediting the money to your account.
So if I get a massive dividend check for, say, 20,000 rupees, it's going to be light by 2,000.
Yes. Now remember, TDS is not an extra tax, it's just an advance payment of tax. You can claim credit for that 2,000 when you file your return if your actual tax liability is lower. But from a cash flow perspective, yes, you get less money up front.
And what about for our friends listening from abroad? The NRIs.
For NRIs, it's a different ballgame entirely. The rules are much stricter. For NRIs, TDS applies to everything, dividends, AD, capital gains. And the rates are often the maximum applicable rates for each category.
So the fund deducts the tax before sending the money abroad to them.
Yes, it's a compliance measure.
Yeah.
The government wants to ensure the tax is collected before the money leaves the Indian jurisdiction because it's much harder to collect it afterwards.
Makes perfect sense. Okay, final piece of this giant tax puzzle before we wrap up. Indirect taxes. GST. We pay GST on toothpaste. We pay it on restaurant bills. Do we pay it on mutual funds?
You don't pay GST on the investment amount directly. If you invest 100 rupees, you aren't charged 18% GST on that 100 rupees. That would be insane.
That would kill the entire industry overnight.
It would, but GST is charged on the services provided to the fund.
You mean the management fees that the AMC charges?
Exactly. The asset management company charges a fee for managing your money. The distributor gets a commission for advising you. These are considered services, and they attract 18% GST.
Who pays that? Does the AMC pay it from its pocket?
No, the scheme pays it. And because the scheme pays it, that cost is ultimately borne by you, the investor, because it comes out of the fund's net asset value.
So it's another one of those invisible costs.
It is embedded within the total expense ratio, or TR. When you see a fund that has an expense ratio of, say, 2%, that 2% figure already includes the management fee and the GST on top of that fee. You don't see it as a separate line item, but you are paying it every single day as a tiny, tiny reduction in your unit's value.
And what about exit loads? If I leave a fund early and have to pay that 1% penalty.
This is an interesting one. If a fund charges you an exit load, that 1% because you left too early, that 1% isn't just kept by the AMC. The government says, hey, that exit load is a consideration for a service. So GST applies to the exit load amount too.
So the government gets its cut even on the penalty I pay for leaving.
The government always gets its cut.
We have covered a massive amount of ground here. My head is swimming with percentages and timelines. We have gone from the high-level structure of trusts all the way down to the minutia of stamp duty. Let's try to zoom out. What is the one big idea you want our listener to take away from all this?
If we have to connect all these dots back to the bigger picture, the key takeaway is that mutual funds are incredibly transparent vehicles. The complexity isn't there to trick you. It's there because the system is trying to tax the end investor fairly based on their specific profile, their income, their holding period. But because it's a pass-through vehicle, the burden of knowledge falls squarely on you. You have to understand these rules.
Right, and it just highlights so clearly the importance of choosing the right option within a fund. Dividend versus growth isn't just a lifestyle preference, it is a critical tax decision.
It's a huge tax decision. If you are in a high tax bracket, the dividend IDCW option is profoundly inefficient. You are paying 30% or more in tax every single year on that payout. It's a massive drag on your compounding.
Whereas with the growth option,
you control the timing of the tax event. The gains are accumulating, but they are not taxed.
Yeah.
You only pay tax on the day you choose to sell.
and that leads me directly to my provocative closing thought for our listeners today. We often obsess over the tax rate. Is it 10%? Is it 12.5%? Is it 20%? But I think we forget about the even greater power of tax deferral.
Go on.
Think about it. When you choose the growth option, your money is allowed to compound pre-tax. All that money that would have gone to the taxman every year in a dividend plan stays inside the fund. It stays invested. It earns returns on itself year after year after year.
That's effectively an interest-free loan from the government for as long as you hold the fund.
Exactly. You are using the government's money, the tax you haven't paid yet, to make more money for yourself. So the question you have to ask yourself is this: do you really need that cash flow from dividends today, knowing you are handing over a huge chunk of it to the taxman immediately and giving up all its future growth? Or can you afford to let it ride, let it compound in that tax-sheltered environment, and pay the tax only once many years down the road?
Don't let the tax tail wag the investment dog, but certainly let the tax tail inform the dog where to sit.
I love that image. Well said. That is it for this deep dive into mutual fund taxation. We hope you feel a little less dread and a little more powered up for your next portfolio review.
Happy investing.